Well, there has been a real cooling in credit globally. So let's find out what this actually means, not just offshore, but for local investors as well. Frank Danieli from MA Financial is here with the details. Frank, it's been a long time between drinks again.
Hi Nadine,
you're
good
off
to see you.
gallivanting.
That's
Welcome
right.
back.
I have been offshore. I was over in Barcelona for the Global Securitization Conference. I've been in Hong Kong, so really seeing what's happening offshore and where sentiment is in the credit markets.
Where is sentiment?
I'd say at the moment, Nadine, sentiment in credit is incredibly polarized. So on one hand, for new deals, you've got the best conditions in a generation. Right now, it is a lender's market. The pendulum has swung firmly in favor of lenders, and so the pricing that's available in the safest part of the capital structure is incredibly attractive, and the terms that you can command, the security you can get is fantastic. And when you can get 8 to 10% type returns or even higher in the safest part of the capital structure with really good collateral, really good security, that's quite attractive. On the other hand though, there are some people and some financiers out there who perhaps in the past, when times were good, when things were buoyant, forgot what it means, I think, to be a lender. And from that cohort at the moment, there is some very concerned sentiment, let's say, because those particular financiers and institutions are facing into a market where their back books could be under quite considerable strain as we do see the impact of higher rates and potentially a tightening global economy.
So that's the lay of the land. What does it actually mean for credit investors right now? When we think about the health of the companies that they're investing in, knowing that there's likely further slowdown to come and tightening in credit conditions as well.
Yeah, well, firstly, if you've got dry powder, you can fund into this environment, and that's very attractive because you can provide solutions to high quality borrowers that are otherwise unable to obtain credit. And as you said, credit conditions are tightening. In fact, our analysis indicates that at the moment, credit conditions for whether they're small companies or large borrowers are as tight as they've been since 2008 or otherwise going back before then, the early 1990s recessionary conditions. So you're seeing a tightness in credit. Credit's harder to come by. So that's a good thing if you're out there picking credit and looking to find high quality loans because you've sort of got the pick of the bunch if you can do that. What it means for people in credit if they are exposed to back book issues is that they could be very, very distracted. That is that we could potentially see quite a default cycle come. And if that happens, then some investors will be really rolling up their sleeves and trying to work out how they protect their capital. Because of course the goal in credit is capital preservation with resilient income. And so you've got to get that capital preservation piece right. And if we do start to see more borrowers under strain in this environment, then those investors will have their hands full.
Okay, so what does this credit default cycle potentially look like? I mean, how does it unfold?
Yeah, the credit default cycle this time I think is going to look quite different to 2008 or even if you go back into the 90s periods. The reason is that I said earlier there have been parts of the market where some lenders forgot what it means to be a lender. And so they've given up on the fundamental rights that lenders need. When you provide someone a loan, you're thinking about three things. You're thinking about, can the borrower service this loan? If they can't, or if something happens to them in the future, whether it's an individual or a company, what security do I have to protect my position? And then thirdly, how do I actually have the rights and controls to get in and protect my capital, so to recover on that security? Now, what's happened in some parts of the market, again, when times were very good, and there was a lot of capital flooding into one or two segments of the market, is that lenders gave up those fundamental rights. So there was a proliferation globally, particularly in areas like the leveraged loan market, meaning funding private equity buyouts, of covenant-light loans. In fact, it got to the point where it's not even covenant-light. There's no covenants at all. And then they started giving up other things, in particular negative control. So these documents are in some cases full of booby traps. There's things like priming, up tiering. They've got names, drop downs, trap doors. There's all sorts of things like this that can happen, which means that the counterparty can take assets out of the lending group, or if things go wrong, the lenders don't have the right to intervene and protect their position, which is the right they should have, given you want to be, the senior part of the capital structure. And so what that means this cycle then is that it's not like you're going to see people or companies or borrowers just default on a covenant and then there's an issue. I think what could happen instead is that you'll see that a lot of these borrowers, in some cases highly leveraged borrowers, start to really struggle to actually service their debt. That is, to actually make interest and principal payments. And then they'll have to go through some sort of a recapitalization or what we call a workout of that position. And so what is starting to be seen globally is a rising incidence of lender-on-lender violence, meaning some lenders coming in, particularly special situation funds that are well placed to recapitalize companies, that is their core business, to come in and take control of these capital structures and do a loan-to-own situation or similar. And depending on the type of investor, not all investors are well placed to I guess participate in that or to fight back.
It's pretty juicy language. It's all feeling a bit dramatic. So are there certain sectors that are, ripe for that kind of violence, of action?
Yeah, I would say that, look, any area where you've got highly leveraged companies, and particularly highly leveraged companies that might be more cyclical in nature, or be facing significant margin pressure. So you could see companies exposed to consumer discretionary or any type of consumer behavior where they're not only facing margin pressures, a higher cost of funds, but also top line issues as consumers cut back, or similarly segments of the market where margin pressure is high. So one of the things that's interesting, again, say in the US right now, is that one of the most stressed areas of the traded loan market is in fact loans to healthcare companies. And that sounds kind of strange because you'd think healthcare is quite a non-cyclical business, but it is also a labor intensive business, and the cost of labor everywhere is going up significantly. There are staff shortages as well post-COVID, and so the margin pressure in that segment is significant, and if the company is also highly leveraged, then they're paying higher costs of debt. And so that could cause them to face issues. So they're kind of the areas where, I think there could be concern. The flip side is that there's a whole bunch of high quality, more resilient, often mid-market or also large businesses that do actually have tailwinds behind them going into this environment, but also where their lenders are facing other issues, whether it's regional banks in the US, whether it's people exposed to some of these other highly leveraged companies. And so the ability to step in and to provide finance for the right type of company in this environment, or for the right segment of the market where you've got really good assets, really good collateral, I think is particularly attractive. So we really like those areas. Direct loans to otherwise high quality companies where the lender can no longer participate, or alternatively loans that have really good collateral and heavy asset backing.
Yeah, because that's where you step in. You're on the opportunity side of this market presumably right now. And do those lessons translate here to Australia as well? I mean, as far as where the opportunities lie?
Yeah, the good thing about being in Australia is Australia generally doesn't lead the world with these things. So you can kind of look offshore, you can see these dynamics happen, and then you can position yourself here. I'd say that we are earlier in this thematic than I've talked about compared to the rest of the world, but I expect to see it come. And I think there's a handful of situations playing out right now in respect of those highly leveraged companies where I think you'll see this kind of dynamic play out. But that also at the same time means that new deals are getting better than they've ever been, and so it's particularly attractive. The other thing that's happening and continues to happen globally and will accentuate here, I think, is that the types of things that banks will do continues to narrow. And we have always found that the best loan is a loan that a bank used to do, but now they can't because of either regulatory pressure or inefficiencies or whatnot. And so if you can step in and provide that, you can provide a type of loan that is in fact bank quality, but you can do it at a better return, and that's really that's the holy grail in credit.